You talked also about an emerging global liquidity crisis, and maybe you could explain what that is. Obviously, last time you were here in London, Jim, you and I spoke about, the long-term capital management crisis of '98, where there was a real liquidity issue, and I think you guys had $1.7 trillion worth of derivatives at the time, and then we saw that happen again in '08. Well, first of all, maybe tell people, what is it like to go through a liquidity crisis? People don't realize how bad things were in '98 or even in '08. And then what would one look like now?
They kind of all look the same. I mean, they pop up in different places. In 1998, it was long-term capital management. The sequence there was interesting because that crisis actually started in June 1997 in Thailand, when there had been a huge capital inflows at a fixed exchange rate. And Thailand said, sorry, we're going to devalue the baht. And everyone said, oh, gee, I borrowed dollars and invested in Thai assets. Now they're worth half. Get me out of here. They dumped everything. And then that spread to Malaysia. I happened to be pretty well acquainted with Dr. Mahathir, who was prime minister at the time. He has some interesting stories to tell about that. Then Indonesia, then South Korea by the fall of 1997. And, the old expression, buy when there's blood in the streets. Well, sadly, there was real blood in the streets in Korea. There were riots and people were killed. And then it cooled off a little bit. And then up pops Russia, by April. And then that came to a head in August of 1998. And the whole world was waiting for Brazil. Brazil was the next domino. Like I said, Thailand, Malaysia, Indonesia, South Korea, Russia. Here comes Brazil. No, here comes long-term capital management. We were we were like a country in terms of size and leverage and all that. And that became the epicenter of the crisis. And of course, I negotiated that bailout, so I had a pretty front row seat. My wife remembers I was getting, if I got any sleep, a lot of people didn't sleep for 5 days, but I said, I got to get at least 2 hours in here because I got to make decisions. And one night I went to bed at 1 o'clock and I was going to get up at 5, but at 3 o'clock, the phone rang. And it was the Italian finance ministry. They were looking for some information on some unsecured loan agreement they happened to be in. We were the biggest holder of Italian government debt. So I took the call, and then she said, well, when you were done, you went right back to sleep. It took you 2 seconds to fall asleep. So that's how crazy it was. But
and you guys were the smartest guys in the room at Long-Term Capital Management. You had, well, I think it was Myron Black, one of the MIT professors that had done
we had two Nobel Prize winners. The creators of the Black-Scholes formula were it was Myron Scholes, Fisher Black, and Robert C. Merton. And it's called Black-Scholes, but everyone recognizes that Bob Merton made indispensable contributions mathematically, and he shared the Nobel Prize. To their credit, by the way, when those guys won the Nobel Prize in '97, Fisher Black had passed away, but Bob and Myron took the money and split it 3 ways and gave 1/3 to Fisher's widow, which was a very classy thing to do. So that was and well deserved, of course. But so we had 2 Nobelists, but the average IQ around the place was like 165 or something. It was crazy. You should always aspire to be the dumbest guy in the room, and I actually achieved that on a number of occasions. We had MIT professors. David Mullins was former vice chairman of the Fed, the youngest full professor in the history of Harvard University, and lesser known names, but well known in the industry. Greg Hawkins, we call him the Hawk. So there was no shortage of talent. But
so John Goodfriend from Solly was there as well.
He was not. John Goodfriend was the boss at Solly when these guys coalesced as the in-house arbitrage team.
Okay.
I just did not to digress too much, but that blew up in a scandal. People went to jail in 1991 because Solomon, it was not our guys, it was Paul Moser lied to the Treasury. He was trying to corner the market in 2-year notes. It was like right out of like 1869. It was the gold squeeze, but he's trying to corner the market in 2-year notes, and there was a ceiling on how much any dealer could own. I think it was 25 or 30% of the issue. But he lied. He said, well, we're bidding for customers, which was okay. And he bought like 70% of the issue. But he lied about the fact that it was for the house account. He was saying it was for customers. And of course, he came close to cornering the market, but it was found out. He went to jail. But that caused the board to fire everybody John Merriweather, was not fired, but he chose to resign in the face of, he was not implicated, but it was kind of like he was vice chairman, so it was hard for him not to be affected. But then they left as a group and formed Long-Term Capital Management. So we moved to Greenwich, Connecticut. So we were the northern version, reincarnation of the Solomon Arbitrage Group, of which Goodfriend had been the boss.
Right.
I met Goodfriend later, spent a lot of time with him. Interesting guy. But
How so?
what they missed,
How so?
what he, in a very well dressed, $3,000 suit and tie kind of way, he was very vulgar. But it was like second nature to him. He wasn't like a guy gratuitously throwing around the F word. It was just the way he talked. And but he was a real Wall Streeter, very wealthy and all that. But he was every bit as vulgar in speech as I had been led to believe. So I was like, okay, you're the real deal. So okay, so you got a whole bunch of 165 IQs and 2 Nobel Prize winners and all the modeling technological capability you could possibly. What did they get wrong? They had an a priori assumption that when spreads widened, when I say spreads, 2 instruments, off the run treasuries versus on the run treasuries, or on the run treasuries versus treasury futures. And you could apply this to anything, Japanese stocks, French stocks, and we did. If they were essentially the same, and should be priced the same and would end up the same if held to maturity, that you want to own that spread and just wait patiently for the spread to converge and then close it out and take the profits. And because the spreads tended to be razor thin, you could apply high leverage. Now, isn't leverage dangerous? Yes, it is. But if you have a sure thing, if you know it's going to converge, and in fact, they were going to converge, you could leverage it comfortably and you were just going to make more money. So that's the idea. So when the spreads widened and you lost a little money on the trade, they would kind of say, well, a good thing just got better. Like the old school traders say, it's nature's way of telling you you're wrong, get out of the trade. But long-term capital is like, wait, good thing just got better, buy more. Widens, hey, buy more. This thing's getting richer all the time. But what's happening, of course, is that you're walking into a trap, because at the end of the day, in a global liquidity crisis, the spreads go like this. And then it's not a cliche, it's true. Markets can remain irrational longer than you can remain solvent. And that was what they missed. We had $4 billion in cash. And we leveraged through futures and all that. And we had $1 billion line of credit. We had repo facilities everywhere. We were tough negotiators when it came to margin calls and all that stuff. And as I say, our accounting was so good, we knew how much we lost to the penny. This was never a case of mismarking or, gee, the market's going to get, what's going on? We knew exactly what was going on. That was kind of the scary part. It was like we did know exactly what was going on. But things like that have 2 stages. Stage 1 is the market's moving against you, and instead of getting out early, these guys double down in what's called a martingale strategy, in the firm belief that it would converge, which it would, but too late for them. But then there comes a time when the word gets out that you're the biggest victim, at which point you're the marlin and the old man in the sea. The sharks come at you. The street doesn't care about the market anymore. They systematically trade against you, and they will not stop until there's nothing left but the bill and the tail.